insurance has a tendency just to be so mind-bogglingly, bafflingly confusing that the thing that makes it simpler is just to go back and understand the fundamentals of it. And it's amazing. This is a bit of a staff training piece I do, so that staff, when they're in the middle looking at some unfamiliar policy, it makes no sense to them. They can sort of locate themselves in the basics and then understand it. So, I'll probably stuff it up, but we'll see how we go. This is general advice only. Okay? You need personal advice, you need to talk to someone. So I just like to overview what I'm going to talk about. This is obviously all to do with insurance. Start with the conditions, the fundamental conditions of any insurance contract, the categories of insurance, classes of insurance, exclusions, how they're packaged, a couple of final truths as a final message, and then some questions. So there's three conditions and obligations that with every contract of insurance, it has to be an unforeseen event. You have to have exercised some due care and you have to comply with the law. So if you're practicing as a solicitor without the right license, you're not going to be insured. So simple so far. So there are actually 5 categories of insurance. There's own damage or your own costs. So that is, I own something and it has been damaged, and because I own it, I want to insure it and get paid for it. There's legal liability, which means I've done something silly. It's caused someone else some sort of damage or injured their person or their property. There's consequential loss, which means, hey, if I only had my car, I'd actually be able to keep working as a courier. But since I don't have the car, well, I've lost this much income every day, or loss of revenue is the typical thing of consequential loss. Now these other two are a little bit more unusual. There's mitigation costs or prevention costs. Now normally you'd think, well, insurance shouldn't necessarily pay for me to avoid a loss, but sometimes it does. So the good example is product recall. So I've produced a product and it's gone out to market, but then we've discovered in our batch testing that actually there's a fault with that product. Now, it hasn't hurt anyone, it hasn't caused any issue, but we've got to get it all back. That's a mitigation expense. It's not a legal liability because no one's sued me yet, but I'm going to have some costs to avoid that. You can insure for that sort of thing. And the final one is the weird one of the group. It's called parametric, and that means the insurer pays you a set amount if something happens. There's a defined event, but it's not, what they pay you is unrelated to how much damage you suffer. So hail cover these days for car yards is normally parametric, where if hailstones of a particular size fall and they're detected, they just pay out whatever the face value is. Well, so that's parametric, fixed payout on a specific event. Now you would think, okay, the most policies that I could possibly need is 5. I'll just list up all my assets and I'll get an own damage policy for all that. I'll list all my activities and I'll have legal liability for that, and so on. But something comes along that sort of changes that. There's not a maximum of 5 policies, because then you've got insurers have different appetites for risk and different expertise. So as soon as you bring that appetite in, it's not that complicated. You just end up with a few classes of insurance that develop out of that, and so it's all pretty simple, really. So that's at least 46. That's just off the top of my head. Once you've got all those classes, and so you've gone from conditions to the sort of categories where an insurance policy is going to fit, the classes that then generates, and then you've got exclusions, and there's really only 3 types. There's activity-specific exclusions, which really reinforce disclosures. And a good example would be if there's an accountant's professional indemnity policy, it's probably going to say you're excluded from providing financial planning advice. because what they're really saying is, well, if you're going to do financial planning, you need to tell us about that. So it's probably just, well, it's to more sharply define the insured activity rather than just relying on what's written on the application form, which can be all free text and all over the place. They say, okay, well, thanks. It's really a way of the insurer saying, this is what we understand that you do, and just to make sure we're all on the same page, all these other things, they're not going to be covered. Then there's cover specific. So that's to define the policy type. So, for example, they want to make sure that property coverage doesn't leak into a professional indemnity policy. So a really common exclusion is failure to insure. So if for some reason it was your job to organise insurance and you don't do it, then you're not going to be covered for that professional risk, because that's really allowing property risk to get into the professional indemnity pool, which the investors on the other side won't really like. Because when you lay your money down to invest in professional indemnity risk, you don't want to find that there's some property risk leaking in through the back door. So that's another reason for an exclusion.
Does that come about from some genius who realises that they only need one cover and that they can claim under this cover by not having that cover, and then they close the loop?
A lot of it just develops over time. I mean, it's, you know, with contract law, litigation, it's a game of cat and mouse. Someone succeeds and all the insurers run around and fix it. Product evolution is driven by this. If you're an IT provider, the only policy you can get is actually a combined professional indemnity, public liability and product liability policy. And, you know, that's all sold as a great little package benefit. But the real reason is that at law, if you don't have one of those policies, you can usually reframe your litigation to hit one of the other ones. Because what's the difference between IT advice and IT product when you're developing software? Is it a product? Is it advice? Is it either? It could be both. But if you know what insurance your defendant has, then you'll make your argument accordingly. So insurers had enough of this and said, well, from now on, we're not selling one without the other. Here's your package. And then it's now sold as a great benefit, but that's the real reason. The other reason is it's an uneconomic risk. So perfect example is flood. Because the frequency is too high, it's uneconomical to offer the cover. And a good example, I'm going to say that an excess is really like a frequency exclusion. That's what they're saying. It's not economical for us to manage claims under $1,000. We'd have to open files. We'd have to do all this extra work. You know, we've got to thin the herd a bit to make this proposition economical, not just for the insurer, but also for the insured, because the extra premium sometimes to have an insurer manage a $1 claim when it's costing them, you know, $100 to even have someone sitting in the seat to look at it. And the other one is severity. So what they're saying with pandemic cover is that the maximum severity, as according to our models, is too much. We can't act. A good case in point is the global insurance industry was technically insolvent immediately following the World Trade Center. There was actually more contingent liabilities to be paid than there was actually insurance pools. And that's when all the Lloyd's names were asked for contributions. They did capital raisings, like, you know, all this money needed to be found to cover those risks. And meanwhile, they were busy trying to trim them as much as they could, had their brightest minds on how we could reduce what we actually have to pay out. You can argue whether that's right or wrong, or that's just what they did. And, you know, the reason why pandemics were excluded is because a global pandemic is more than the insurance industry worldwide could handle. Some of those exclusions, because they were pretty universal, but some of them weren't drafted particularly well, and there may still be some claims related to pandemic on consequential loss, just because of drafting errors, not because the intention wasn't there to avoid the claim. And a good example of an indemnity limit exclusion is a severity exclusion is the indemnity limit on the policy. And saying, hey, we're going to give you $20 million liability cover. So yeah, it could be a $40 million claim, but we're putting a limit. We can't go over that. That's effectively an exclusion. Now, a lot of people wouldn't see it that way, but I think that's a good way to look at it. And there is one more exclusion type, and it's very, very important. That's the dodgy one. Now, if you look at your policy and there is some activity exclusion and it directly encroaches on what you actually do, that's dodgy. Insurers, they might claim it's an accident, but some of the times they do it on purpose. Only in the last 2 weeks, I put up a product, basically a product manufacturer's risk. And one of the insurers responded with these red hot price terms with a product liability exclusion. Well, what's the point of that policy? Like, why even respond? Another one I had, this guy was building jetties actually, but we disclosed that he used a lot of contractors, and one insurer responds with a policy that has a blanket contractor injury exclusion. I mean, So yeah, you do actually have to be on the lookout. It's not that exclusions are there to be dodgy though. Like fundamentally they serve a purpose, and if they define your risk and do all those things that I mentioned, they're great because they make it an economic proposition. But you will get, especially at the coal face, you'll get someone who's a bit under the pump for budget. And I really want to get this policy. I could probably write it if I throw this in. Oh, well, And it's kind of up to clients, but also brokers to review these things and ferret them out. And they're always full of surprises. Now we get to packaging. So all those 46 plus classes of insurance are often packaged together. And these are common package names, but a business insurance policy, there's no class business insurance. It's not actually an insurance class. It's a multi-section policy. It could be different from insurer to insurer. The typical sections, there's public liability, property damage, theft, glass, all sorts of things can be thrown in there. But you're not really going to learn anything by knowing someone has a business insurance policy. You've got to see through that package to what classes are in there. So now that I've confused everyone, I'll just give you some truths that will help practically with understanding insurance. The first one is, and they're a bit brutal, if you own it, it's your responsibility to insure it. So yeah, I've given my package to a courier. Oh, but surely, if something happens, no, they're not going to replace it. I mean, they have a liability policy, but not everything's going to be their fault. If you own something, you insure it, no matter what. If you leave it in a storage shed, that's another classic. People think, I've left it at, national storage. I tell you what, those guys better look after my stuff. Well, they don't. No, if it's damaged, you've got to buy it. And if you do have any recourse on them, it could be months away, years away.
Sorry, guys, when you book a flight on Qantas or whatever, and they say, would you like to protect your baggage or whatever? What's the deal there? Do you need that insurance? It seems like it's got about a 75,000% markup on it to buy a single trip insurance for $20 or whatever it costs.
And they put the insured bags in one section of the plane. To make sure they take extra good care of them.
So without the cover, they'll be legally liable if they do something wrong, if they breach their duty of care. They can't contract out a duty of care over your bags. But again,
if the plane gets shot out of the sky, it's not their fault, basically.
And also the other thing is under transport.
You went down with the bags, presumably.
But if your bags. But if your bag turns up, 4 months after you lost it, and they've contracted out of their consequential costs, they actually might have no liability. But you haven't had your bags for 4 months. The reason for the big markup is convenience. There's other ways to access that sort of cover. It's essentially saying here is a property damage cover for your bags. You can buy it now. It's very convenient, and it's marked up for the convenience. Or you could just have a travel insurance policy and it's included. But a lot of the biggest markup is around convenience.
Yeah.
The second truth is if you act, you can make a mistake affecting others. If you drive a car, you can have an accident. There's no way, oh, no, I'm really, really careful. No. If anything happens, it'll be someone. Oh, you hear this all the time. So just stop kidding yourself. If you undertake any activity, you could affect someone else with your actions. Walking down the street, you could be on your phone and you run into someone. That's a public liability claim, potentially. And the other truth is you cannot rely on anyone else's insurance, ever, no matter what. So you get people who say, I'm exhibiting at the convention centre. They'll have liability insurance, won't they? Yes, and it'll cover them. It's not going to cover you. So if there is something that goes wrong and they're hit with a litigation, well, they'll have their insurers appoint a lawyer and defend it all, but they're not going to. Their lawyers aren't going to act on your behalf, and their insurer isn't going to pay any of your claim. Now, you can get extensions to include contractors and other people. That's quite a deliberate situation, and effectively that doesn't mean it's someone else's insurance. It means you're sharing it. It's your insurance. It's just maybe bought as a package or you're extended onto it, but it's not. You're not relying on someone else's insurance. Someone else may be organising it for you. Like when you tick the box on the travel thing, that's your insurance. So you just allowed someone else to organise it for you for convenience. It's not like Qantas, you're participating in their insurance. And that's the three truths. And that's my advice to make all this work is just start with a risk assessment. Whether you do it yourself, but we do one, and that's the little QR code you can scan. It's on my business card, but it's just the best place to start is to say, okay, I would like a list of all the risks and what are those classes that are relevant to me. Of all those 46 more plus classes, which are the 8 or 9 that I need to be thinking about? And when you've got that list, at least then you can sort of get started. And that is it.